Today, I'll help you keep tens of thousands of dollars you're currently losing to invisible investing fees. You'll walk away with a simple checklist to spot and slash them: expense ratios, advisory AUM fees, trading spreads, and tax drags, so more of your money compounds for you. Later in this video, you'll discover the single shift that quietly protects your returns for decades. Miss it, and you could work twice as hard for half the wealth. If your money looked you in the eye and said, "I'm leaking," where would you check first? My real story. A few years ago, I learned this lesson the hard way. I owned a star fund with what seemed like a reasonable fee. Slick reports, confident managers, sharp suits, the whole show. I felt safe, convinced I was doing it right. Then one weekend, I compared it to a plain index fund. Same years, same deposits, same market. My flashy fund lagged badly. The culprit wasn't bad investing. It was the cost of style over substance. That hit hard. I wasn't losing from bad luck. I was paying for the privilege of underperforming. So I switched, ditched fancy for simple, and my money started compounding faster than ever. If you've ever trusted the experts and still felt stuck, you're not alone. Let's find your leaks and plug them before another year slips by. Level 1. The fee that eats your retirement. You can choose solid investments, contribute every month, and still retire with far less, just because of fees you barely notice. A 1% annual fee sounds harmless, but over 30 years it can shrink your ending balance by about 25%. That's not theory, it's basic compounding math. Imagine saving faithfully for decades, doing everything right, only to lose a quarter of your nest egg to silent costs. Morningstar found investors paid more than $100 billion in mutual fund fees in a single year. That's enough to fund the retirements of hundreds of thousands of families. Most never realize it happened. If 1% can erase that much, what's 2% quietly doing to your future? Level 2. The Big Four Silent Thieves. 4 culprits cause the most damage: expense ratios, advisory or AUM fees, sales loads, and 12B-1 charges, and trading costs hidden inside bid-ask spreads. Each looks tiny on paper, but compounds against you over time, like termites in wood. Every year, they chew away a few unseen dollars, and 30 years later, the structure still stands. But it's hollow. Which of these silent thieves has been hiding in your portfolio the longest? Level 3. The Expense Ratio Trap. The expense ratio is the most visible and the most ignored. An index fund at 0.03% versus an active fund at 0.85% seems trivial, until time magnifies the gap. 2 investors each put $500 a month into the market for 30 years. The only difference is fees. The low-fee investor ends up with over $70,000 more. Jack Bogle once said, "In investing, you get what you don't pay for." Costs echo for a lifetime. If 2 funds follow the same index, why pay 20 times more for the same ride? Level 4. The Advisory Fee Illusion. Advisory fees can be useful for complex plans, but most people never check what they're really paying. A 1% AUM fee compounds against you every year. It's like hiring a gardener who trims your yard and keeps a slice of land each season. You end up with less lawn, even when the grass looks perfect. Ask your advisor to show you the dollar amount you paid last year, not just a percentage. Seeing it in real dollars changes everything. If you had to write that check right now, would you feel you got your money's worth? Question of the day. What's one fee you've paid in the last year that surprised you? And what will you do to cut it this month? Drop your answer in the comments below. Level 5. Paying to enter, paying to leave. Some mutual funds charge when you buy, charge again when you sell, then tack on annual 12B1 fees for marketing. You're paying to walk in, paying to leave, and tipping the billboard outside. It's like paying just to shop. In a world of commission-free ETFs and zero-load funds, that's an unnecessary toll booth. If the open highway costs nothing, why keep paying to use the same road? Level 6. The hidden cost of busy funds. Every trade creates friction, spreads, taxes, turnover. High turnover funds chase returns like gamblers at slot machines. Each pull costs a little more until the house wins. Low turnover index funds aren't flashy, but they're efficient. Quiet funds compound loud results. Over 20 years, that silence adds thousands to your pocket. Is your fund busy or truly productive? Level 7. The checklist that cuts instantly. Here's your quick action plan. 1. Pick ultra-low fee index funds, 0.03 to 0.10%. 2. Ask for advisory or platform fees in dollars, not percentages. 3. Avoid any fund with sales loads or 12B1 fees. 4. Favor low turnover funds for tax efficiency. 5. Review yearly and switch if fees creep back. If you applied this checklist tonight, which fee disappears first? Level 8. The single shift. Here's the mindset that protects you for life. Make cost your first filter. Before you invest, ask, what's the all-in fee, including taxes, spreads, and platform costs? If a fund can't beat a low-cost index after fees, why own it? Warren Buffett said, when trillions are managed by Wall Street, fees eat up a disproportionate share of the gains. Don't let that be your story. If you treated fees like a leak in your roof, how quickly would you fix it? Level 9. Start small, win big. If this feels heavy, start small. Cancel one high-fee fund. Move one account. Save one leak. Even $10 a month redirected can grow into thousands over time. Wealth isn't built by chasing hype. It's built by plugging holes and letting time work. Money you keep grows faster than money you waste. And the first step to wealth isn't earning more, it's keeping what's already yours. What small win can you lock in before this weekend's? Level 10. The quiet wealth principle. True wealth isn't loud, it's consistent. It doesn't demand attention, it demands discipline. Every dollar you protect today quietly builds the freedom you'll feel tomorrow. Now that you know how to spot and slash the secret fees that quietly steal your returns, you're going to need to know which simple, low-cost portfolio actually keeps most of the gains while staying easy to manage. If you don't know this, you'll cut fees but still scatter your money into funds that don't work together, and you'll miss the calm, steady compounding you're building toward. The secret is in my next video. It's all about the one strategy that makes your entire portfolio run itself. You don't want to miss it. See you in our next video.